Well, Juan, we are so glad you can join us for what is the first in a series of JFL Total Wealth Management webinars we are doing over the next few weeks. We know that the last month has been extremely challenging for all of us. It's been an emotional, financial, and professional roller coaster. And with the stream of information changing daily and often hourly, I think it's times like this that we realize how much we really share in common. Today, JFL wants to provide some perspective that's been going on in the market, as well as some planning strategies to consider. We encourage you to send in questions through the questions feature on the webinar panel, and we will answer as many as possible at the end of the presentation. Without further ado, let's introduce our two financial advisors and certified financial planners, Jerry Lynch and Jeanne Kane.
Hello, everybody.
Hi, good morning.
How are you today?
Thanks for taking the time to join us today.
Okay, we over here and tell you some things I think would be kind of interesting. Okay, we're going to go over a couple of things today. First of all, I want to go over some recent updates in terms of the market, some of the laws that are out there, really what's happening that has an impact on you. I want to talk a little bit about what's happening in the market, the volatility that we're experiencing, and how I see that we're reacting to it. Some of the investment and planning strategies that we've already implemented year to date and that we're planning on continuing throughout the year. Talk a little bit about the CARES Act, and we're going to have more and more information coming out on that simply because this came out literally a week ago. And for example, the Small Business Administration, the PPP Act, is supposed to be going live today. I just got off the phone with my bank. They have no idea how to administer it. So it's going to be kind of interesting. And at the end, we'll have time for question and answers. I would say if it's a very specific question, we're probably better off waiting and having a conversation offline because a lot of times with specific questions, the answer is going to be it depends. But with that, I'd like to talk a little bit about, let me see, let me get this thing to move. Is it going to move? Oh, that's interesting. Gretchen, could you make that move for me?
Yeah, sure.
Okay, next I'm going to talk about some of the kind of what's in the headlines in the U.S. And worldwide. So the U.S. has more people infected with the coronavirus than any other country in the world. As of today, there are more than 240,000. Worldwide, that number of cases has topped 1 million. Over 80% of the U.S. population is under stay-at-home orders. That's over 270 million people in some form of lockdown. Unfortunately, we still have some time to go as President Trump has recently extended his social distancing guidance through the end of April. The federal tax return deadline, that was extended until July 15th. Now, you'll need to check with your state for the exact date of when your state taxes are due, because that may differ. For those who live in New York and New Jersey, your state tax deadline, that also has been extended to July 15th. Now, last week, the government passed the largest stimulus package ever when it approved the $2 trillion stimulus package, which is to provide assistance for both business owners and individuals. We're planning to do additional webinars in the coming weeks to go over the details of the plan.
Now, the first question people ask me is, what's a bear market? And a bear market does not mean we're in a recession. A bear market is really an indication of the stock market, and if it drops off its historical highs of more than 20% or more. This is something that happens on a very systematic basis. And again, the stock market is not really an indication of how the economy is running. To a certain extent, it is. If things are working well in the economy, you'll see the stock market will increase over a period of time. But for example, in the fourth quarter of 2018, we saw a very big decline in a very short period of time, and there really wasn't anything wrong with the economy. So again, when we see a bear market, it's an indication that basically the stock market is down and not necessarily there's something wrong with the economy. Gretchen, can you get that next one? Terrific. Okay, now do I have, Gretchen, could you do me a favor and just from, oh, here we go. I think I got it here. Yeah, here we go. everybody can see this in my, oops, sorry, my drawing's not that good. Okay, now this is going back to 1970 and taking a look through now. And one of the things that we see is that it goes up and down. It looks very much like one of those heart machines where you see a lot of different ups and downs in a very short period of time. But if you see a trend, the trend is that generally it goes up. Now, I'm going to walk you through some of the history that I've had, and you could realize how old I am by the responses and comments that I make. Back in the 70s, I got a job working at a gas station for two reasons. Number one is I wanted to get the $2.35 an hour, which was the minimum wage. And then secondly, so that my dad could pick me up in the evenings and get his tank filled. Back at that time, there were lines, there were odd and even days. And at the time, everybody said, but this is different. They had never seen anything like that. You had the Reagan years when I got out of college, and one of my first jobs was selling vinyl siding door to door, where people would reuse a home equity line of credit at 18% to pay for those loans. We have the Black Monday crash, where in one day, the stock market dropped 22%. Market bulls, you had the 2000 tech bubble, where again, we saw a very substantial crash, and then 2008, when we had a very substantial crash and so forth. Now, over this period of time, if you were to take a look at the numbers from 1970 through now, what you would see is that if you had invested $10,000 in 1970, you would have 41 times that over that 50-year period of time, okay? Now, when I'm looking at these numbers too, there's a couple of things that I would say is that when you're in these market dips, and I'm just going to kind of circle some of them, everybody thinks that there's something bad happening over that period of time. And what I would tell you is that, especially if you're working right now and you're investing in your 401k plan, these are some of the best rates of return that you have when you're investing. Now, when you're living off your income and you're a retiree, it could be some of the most stressful times that you have, because you're seeing part of your net worth going down and you don't have an opportunity to recover. But a few points I'm going to say there. Historically, what we do with our investments is that when we have these good times here, we have three different buckets of money. We have a conservative strategy, a moderate strategy, and a more aggressive strategy. So over these period of time, we're taking money out of the stocks and we're putting it into more conservative investments so that we could continue to focus on your cash flow. And it's taking out some of the peaks and valleys. Now, one of the things that I would say is if we could go back down to 2070 and we could put money in, knowing that 50 years from now, we would have 41 times that amount of money, how many of you would make that investment? Just knowing that even with the ups and downs, 40 years or 50 years on, you have that rate of return. Now, some of you will say, well, listen, I don't have 50 years. And that's totally fine, because in these periods of time when we're having these market increases, we're taking that money off the table, we're protecting your cash flow, and we're making sure that we have these declines, we never have to sell anything at a discount. Now, I'm going to mention to you one thing that was taught to me a while ago, which is the rule of investing. And I've mentioned it to you many times. 4, 4, 4. What that means is 1 out of every 4 months, you're going to lose money in the stock market. 1 out of every 4 quarters, you're going to lose money in the stock market. 1 out of every 4 years, you're going to lose money in the stock market on average. But it also says 3 out of 4 times we're going to be successful in all those opportunities. Now, if I could go to Las Vegas and I could bet, knowing that 3 out of 4 hands I would win, I would consistently make the same bet over and over and over again. I wouldn't increase my bet. I wouldn't decrease my bet. I would be consistent. And if I'm consistent over a period of time, I'm going to get consistent returns. Now, again, for those of you that are retired, we've already structured your portfolio so we don't have to sell stocks at a discount. We are putting you in a position where in the conservative investments, we can last quite a few years without ever having to sell anything, which allows us to get those reasonable rates of return. Gretchen, could you hit the next one?
Sure.
Thank you. Okay. Now, what happens if you miss a few days? What a lot of people have said to me is, you know what? Why don't I just sit this one out? Why don't I just take an opportunity to kind of put my money into cash and just kind of wait until this thing blows over, and then we'll see what happens. And this is just looking at the stock market over a 20-year period of time, a 40-year period of time. All right, if you had missed the best 5 days, your returns would have been cut down by about 30%. If you have missed the best 10 days in 38 years, your returns would have been cut down in half. If you would miss the best 30 days, your return would be about 25% of what it should have been had you remained consistent in the market. And I think that's incredibly important to understand, is that generally the best days in the market are right after the worst days in the market. And if you're sitting in cash on the sidelines, you've locked in that loss for the rest of your life. Can you tap that for me? Okay. Now, again, this is just looking at the stock market since 1995. And really what we're just looking at here is that from here to here, there really wasn't that much of a gain. That's interesting. Oh, here we go. And people would say, well, that was terrible. Well, again, during this period of time, people were making money. Again, if we were retired at this period of time, at this period, we would be taking money out of the gains that we had in the portfolio, putting them into the conservative areas. And then from here to here, we had a tremendous rate of return, basically around 288% over this period of time. So the key here again is that at periods of time, the market's going to go up tremendously high. And the key here is to remain consistent, because if we do, we're going to get reasonable rates of return. Can you go to that next one? Thank you.
Okay. So let's take a look at how various asset classes have performed over the past 15 years. Jerry, who has control? If you can kind of go to the top of the chart. Thank you. Okay. These are the asset classes that had kind of the best returns, and at the bottom of the chart are the ones that had the worst. So thanks. Thank you, Jerry. If you go back up to the top, you'll see there's the emerging markets, fixed income, those are bonds, small caps, smaller companies, and the S&P 500. So across the board, there's not one consistent asset class that has been at the top the entire time. And if you go down to the bottom, it's kind of the same thing. It's a different pattern. It's not the same asset classes each time. Now, if you look at those dark blue blocks, you see those ones right in the middle? Okay, perfect. These represent a balanced or a moderate portfolio. The vast majority of our clients are in moderate portfolios where your stock allocation is about 60%. These portfolios had returns that were in kind of the middle of the pack. So as Jerry's kind of moving along, kind of in the middle, they're not designed to give you the highest returns, nor do they get the lowest. Our portfolios are designed to give you a reasonable rate of return for a reasonable level of risk. Now let's take a look more specifically at 2007. Right at the top there. Okay, so at the top, you've got emerging markets there. The top, top performer had almost a 40% return. Now look at 2008. Go all the way to the bottom there. Yep, emerging markets there had the worst performance, lost over 53%. If you do the same thing, if you go to the top for 2008, you'll see fixed income is the highest. You can even look at the bottom, see fixed income is kind of the lowest there. Now, this is a great example of why we rebalance our portfolios. Rebalancing takes those gains off the table and gets the asset classes back into the right proportion. Can you advance the slide? Okay. So what are some investment strategies? What are your options? There really are 4 options. Number 1, you could sell everything and move your portfolio into cash. Second option was get more conservative. For example, decrease your stock allocation from 60% maybe down to 40% or lower. Third option, kind of stay the course. And the fourth option would be to get more aggressive, maybe increase your stock allocation. Hey, Jerry, can you talk a little bit more about these in detail?
Yeah, I think when I'm looking at the first 2 options on the list, going to cash and becoming more conservative, that's like the opposite of what I want to try to do within anybody's investment portfolio. I don't want to sell low and buy high. And when we get out of the market at this moment in time, basically that's exactly what we're doing, is we're selling stocks that there's really nothing wrong with. So for example, Apple Computer has come down probably 30% since the beginning of the year. I mean, people are still going to have their iPhones next year. People are going to have their Macs. They're going to have their Apple Watches and all their Apple technology. Microsoft is going to be in business 5, 10, 15 years from now. We're owning companies that are very solid companies. There's nothing fundamentally wrong with them other than the fact that they're part of the stock market, and over that period of time, they came back. Now, again, some people say, well, this is a great opportunity for us to sell out of some of our bonds and even get more aggressive. Now, again, I'm always going to bring back the basics, 4, 4, 4. If I'm going out to Vegas and I'm making that same bet over and over and over, and I'm winning 3 out of 4 hands, I will do very well. If I start changing my bet, if I start doing things differently than that basic strategy that works 75% of the time, I am going to mess up the odds of being successful. Now, one of the things I would tell you is that we plan in anybody's portfolio and in our overall financial planning that bad things will happen. So for example, I have life insurance, I have disability insurance, I have long-term care, I have home insurance. If my home was to burn down, all right, I would not be happy because I had a homeowner's policy. I would be ticked off, but I would be glad that I had planned for it and I didn't have that additional cost. When we set up your portfolio, we set it up with the intention that bad things are going to happen. And when bad things happen, you're not going to be happy that you had a plan around it because you're still going to have some level of pain. However, as long as we don't have to sell anything at a discount, we're going to be fine. And that's exactly what we did with the portfolios we set up for you.
There we go. Okay, so I was going to talk a little bit about some planning strategies. Thank you there. Okay, so the first strategy would be rebalancing. And the purpose of rebalancing is to bring your portfolio back into its original asset allocation. We did this in January when we made some changes to the funds in our models. We also did this last week to get the asset allocation back where we wanted it to be. In doing so, we sold out of some bond holdings and bought into some stock positions. Now, another option, there we go, buying low and selling high. This is kind of the #1 rule of investing. With the market down, there are opportunities to invest in great companies and funds that are selling for much lower than where their valuations should be. As Jerry showed you earlier, down markets don't stay that way forever. And there's some tax planning strategies we can look at today as well. First one is tax loss harvesting. This is really just a fancy way of saying that you sell stocks when the value's down, you can get a tax deduction. So for example, we had many clients, if you've been with us for several years, that were invested in SEI funds. These were expensive and the performance really didn't justify the higher cost. We've had a hard time, getting out of those funds and selling out of them because the gains were so high. Recently, we were able to take advantage of the market downturn to get out of those funds in a relatively tax neutral way. Another kind of tax planning strategy, the Roth conversion. Converting in today's economic environment allows you to take advantage of lower asset values. You get more bang for your buck converting when the market's down because you'll owe taxes on a lower amount that grows tax-free for life. Plus, today's tax rates are at historically low levels, and realistically, those could go higher in the future. And the next one, up there, the emergency fund. We want you to kind of review all your sources of income and understand your cash flow needs. You should have between 3 and 6 months worth of living expenses in your emergency fund. So should you suffer a job loss or any other event, you have those funds set aside to get you through. And retirement planning. If you're contributing to your 401k or to an IRA, we recommend you continue to do so. And even look at increasing how much you're putting in. By putting in more now when the market's down, you're buying at a discount and your dollar goes further. And then finally, these are challenging times, and we're here for you as we weather the storm. As unsettling as it feels today, we're going to get through this, and the market will come back and will rebound. Okay. So what can you do now? Well, there are kind of things we want you to focus on. You can focus on your physical, financial, and emotional health. These things are under your control. First and foremost, do what you can to keep your family and yourself safe. Please stay home unless you absolutely must go out, and practice social distancing if you do. The doctors tell us that there are 2 of the best ways to stay safe are, #1, wash your hands, and #2, don't touch your face. And please know, we are keeping a very, very close eye on your portfolio. From a financial standpoint, you can also review your budget and understand what money you have coming in and going out. These are challenging times, and it's important to understand what your cash flow needs are. And finally, find a way to smile and laugh every day. It's so stressful, but finding a way to have fun really can help. There's some great apps and tools out there to connect with friends and family. Just because you can't be physically together, it doesn't mean you can't be in touch. I actually was on a birthday Zoom last night with some friends, celebrating a birthday. We couldn't all be together, but it was still really great to connect.
All right, so basically, I think Warren Buffett is probably one of the best investors I've ever experienced. Again, I've read a lot of his stuff, and I think he's amazingly disciplined in his approach. And he in 2008 he bought into Goldman Sachs at about $140 a share. Within 3 months, Goldman Sachs was down to about $70 a share. What most people would say then is, listen, I got to get out of this. I've lost as much as I'm willing to lose. I'm just going to take my losses and walk away. Well, he didn't walk away. He stayed. And then after that, he basically made about $3.5 billion on that investment that he made. So a lot of times when you see these types of market declines, you're saying to yourself, what should we be doing differently? What changes should we be making to the portfolio? And one of his great quotes is, much success can be attributed to inactivity. Most investors can't resist the temptation to constantly buy and sell. The holdings that we have for you are solid holdings. There's nothing wrong with them. They're just down because the market's down. Now, one of the things that I take pride in more than anything, and I've been in insurance and financial services for almost 35 years, is not one person I've ever worked with who retired ever had to go back to work. Think about that for a second, okay? We've been through 2000, we've been through 9/11, we've been through 2008, we've been through a lot of different types of terrible market declines. And through that, consistently, the people who have been disciplined in their approach have had success. And success in my mind is retiring in a lifestyle that I've become accustomed to and not having to go back to work because I have to. Now, I do have people in their 80s who are working because they want to, and they're having a lot of fun doing that. That's totally different. Nobody that we've ever worked with has had to go back to work due to a market decline, and I'm not planning on changing that right now.
Okay, so we're going to talk a little bit about the CARES Act. It's a $2 trillion stimulus package. Now that's about 10% of the U.S. economy. However, if you add in the $4 trillion in loan guarantees that the government is providing to companies, this number jumps to $6 trillion. And that's about 30% of the U.S. economy. It can be kind of hard to quantify what a trillion really is. What's the difference really between a million, a billion, and a trillion? Sure, you can add in some extra zeros, but it can be hard to wrap your mind around just how big $6 trillion really is. So here's one way that I like to look at it. If you look at it, a million seconds, that's almost 12 days. A billion seconds is about 32 years. A trillion seconds is 31,709 years. Now multiply that by 6. Bottom line, this stimulus package is huge. And this is phase 1. The US government said there could be additional phases to come, and they're really going to do what they can to help support the economy during this time.
So the CARES Act was something that was implemented literally last week. And there's a couple of big things that are happening out there. Number one, dealing with unemployment coverage. Normally, self-employed individuals are not eligible for unemployment insurance. Okay, you pay into it, but you're not eligible for a benefit. Under the new rules, if your income is cut by at least 20%, you qualify for either a partial benefit or a full benefit. So there is an elimination of a waiting period. So they will cover the first week of unemployment. There's a bonus check for the first 4 months of up to another $600. So in certain situations, I think this is bananas, but people will make more on unemployment than they will if they were working full time. And there's an extension of benefits providing an extra 13 weeks of unemployment insurance. Now, again, I think these programs will continue to change. So if they see that this thing is not working, they will add more to it. One of the things, too, that I saw, there was a very interesting program on 60 Minutes where they had the individual who was responsible for 2008 bank cleanup talking about that. He's one of the Fed chiefs out in the Midwest, and very smart individual. He was actually a rocket science for NASA, and then he got an MBA and went into banking, Goldman Sachs and stuff like that. But he basically came back with the attitude that the government will do, the Fed will do whatever it has to maintain the U.S. economy. They have the ability to lend money, they have the ability to back up investments, they have the ability, if they want to buy into the market. I don't think the Democrats or the Republicans want to see the economy tank. If this virus kills us, it doesn't kill us, and we basically have an economy that's lame, lose through this program, and the government is focused on doing whatever is necessary to continue and make sure that we're all going to be well financially through this.
One of the other parts of the CARES Act is the direct payments to taxpayers. This is a case that most Americans will get some form of a check from the government. Individuals can get up to $1,200 and couples up to $2,400, excuse me. Keep in mind there are income phase outs. So if you're single and your adjusted gross income is $75,000 or less, you get the full $1,200. If your income's above $75,000, that payment gradually phases out. The process works for the same for married couples. The only difference is that the threshold is higher. To get the full $2,400, your adjusted gross income needs to be $150,000 or less. And if you earn more, that again, the payment's going to gradually phase out. So if you have kids, you may be eligible to receive $500 per child. However, that the child needs to be under the age of 17 to qualify. You know, there's no limit to the number of kids that you have that can qualify. So if you've got 4 kids, 16 or younger, you get $2,000, so $500 per kid. If you have a child who's older than 17, it may make sense for them to file their own tax return, as they may be eligible for their own $1,200 payment.
And just one quick point with that too, there is no benefit really of having 17-year-old kids on your tax return. You don't get an exemption anymore in the Trump tax program. There is no benefit unless they're below certain ages. There's a child credit, but at that age there isn't. So there's no disadvantage of doing that. And if your child earns up to 12,000 plus of income, they get that income tax free. So there's no disadvantage. And with this type of program, if they file their own tax return, they should qualify for that $1,200. And another provision of the CARES Act is that retirement plan loans have been increased. Historically, it's only $50,000. I could take a distribution actually from an IRA of $100,000, and I have the ability to pay it back up to 3 years later and pay no income tax on it. Or I could take out the taxes over a 3-year period of time. I could do it all in 1 year. I could do a third, a third, a third. But this gives us access to money if I'm in some kind of dire straits. And I think it's a pretty interesting program. Okay.
So that was lots of great information that was presented. So now we're going to talk about a couple questions that have come in, as well as some questions that came in from some of our clients before the webinar started. So the first question is, I'm retired. Can I still get a stimulus package CARES check? Do I still qualify for one?
Gary, I'll go ahead and take that question.
Okay.
So in order to qualify for the stimulus check, the $1,200 or $2,400, really is based on your adjusted gross income. So if you're retired and your adjusted gross income is less than the thresholds, the 75,000 or excuse me, 150,000, you would be eligible for the full credit. It doesn't matter whether you're retired, if you're taking Social Security or not taking it. It really is based on your adjusted gross income. Now, a couple of things to keep in mind too. If you haven't filed your taxes yet, to make sure when you do fill them out, there's a place where you can put in kind of a direct deposit in there. That way, the check doesn't come via snail mail. It's going to come to you directly into your checking account. And if you have already filed them, the IRS is working on a place on their website so that you can put in that information, put in the banking information, so you'll be able to get your check faster as well.
Do you know how often the CARES Act will pay the $1,200 to individuals or $2,400 to married couples plus the $500 per child? How often those payments will occur?
I'll take that one. Right now, it's not definitive. I mean, right now, what both parties are saying is that they'll do whatever they have to get through this thing. Right now, the goal is one check, and then hopefully everybody, between the unemployment benefits they have, there's a lot of stimulus going out to business owners and so forth. They're hoping that that's enough to get us through. Now, if it's not enough, they're working on Plan B, Plan C, Plan D. They're talking about having potential infrastructure bills and things like that. So again, right now there's one, and it should be out relatively soon. If you had direct deposit set up for your refund check, it'll come automatically into your bank account. If not, they'll be sending you a check.
Okay. How long do you think it might take before things will get back to normal?
That's also a very good question. I wish I could say. There's a few issues that we have here that really have to be addressed. First and foremost, we got to stop the spreading of the virus. We got to basically social distance. We got to do whatever we can to sit in our places and do what we have to do to get through there. And if you see kids playing basketball and doing things like that, you got to yell at their parents and say, listen, your kids are supposed to do that. You shouldn't be allowing it. The second thing is, if we do that, we give the scientists and the professionals an opportunity to come up with solutions to this thing. We could stop the spreading. The hospitals won't be as busy. We could come up with some kind of solution. There's a lot of very, very smart people that are out there, and they're going to come up with something that works. The third thing is, I mentioned this before, is the Fed has committed an unlimited amount of money to be able to solve this and get through it. So there's stimulus packages that are literally going out today that will allow business owners to pay their employees for 2.5 months and get a refundable loan from the government, meaning that the government will say, if you do this and you keep your employees, you don't have to pay this thing back. So they're doing whatever they can to basically help businesses get through this. And I think the last thing is that I am amazed at what companies are doing out there to support people during this time. I see Tesla and GM basically making masks. I see Robert Kraft, who I am not a Patriots fan at all, but he donated a boatload of masks to hospitals in this area. You know, J&J, other companies as well too, that are retooling their businesses. If you take a look at restaurants that have never delivered, they are now delivering. These types of things change how businesses work. And I think companies that are out there doing what they can to get ahead are going to come out of this so much stronger than they did before. There are definitely going to be businesses that go out of business because of this, without a doubt. However, there are companies that are going to basically accelerate through this thing because people are going to say these companies care. These people are doing whatever they can to support us. And when we get through this, we're going to kind of come back. So again, I think it's going to take some time. I wish I could tell you definitively by June, everything is going to be fine. But I think, again, there's a process. We got to stick with the process. The first thing is we got to stop the spreading. We got to allow the representatives, the smart people, the ability to come up with solutions for this. And then we got to focus on getting back to business. That's going to take some time.
Okay. So here's one other question. If I max out my 401k this year, do you recommend increasing the percentage now to take advantage of the down market or leave it alone?
Again, that's a tough question. If you got the cash to do it, I mean, my focus for anybody, the first question I always say is, how's your cash flow? How much you have in a bank? What do you got liquid? You know, where are we in terms of protecting our assets? Because, you know, generally, I say this to you all the time, if you're going to give me money or you're going to invest money, you got to invest it with the opportunity of that being there for a minimum of 5 years. Okay. So if you have your cash flow taken care of, I am fine with you increasing your contributions. You know, when I showed you that pie chart or that chart before going up over 50 years, you saw a lot of dips. If I could go back to 2000 and 2008 and after 9/11 and I could do one thing different, I would have invested more aggressively during that period of time because I would have the ability to buy everything on sale. You know, and a lot of times we get very nervous and we say, you know what, I don't want to do that. But those are opportunities of a lifetime. So again, as long as your cash flow is protected and you're fine, I am fine with you getting a little bit more aggressive investing in your 401k plan.
Okay. And how about I think we have time for about one more question. Someone is asking if you could elaborate a little bit on the payment protection program, or forgive me, it's the PPP loans, so the Paycheck Protection Program loans that I think were just released today, or the application process just started today.
Okay, well, first of all, we're gonna have something separate specifically for business owners because there's a lot of details that are associated with this. The PPP basically is a program that the Small Business Administration Treasury has put out where companies that have less than 500 employees can apply for a loan from the government that could be used based on hire and retaining their employees. And if they retain their employees over a period of time, that would mean that the loan is totally forgiven. So if you take a look at these businesses, and the loan could just $10 million of forgivable loan. So for bigger companies up to 500 employees, they can make their employees for 2.5 months during this period of time and still have the government pay for it, which is terrific. Now, this is the issue, is yesterday I talked to TD Bank, which is my bank, and this morning I had a phone call with them. They actually called me up. They don't have a clue how to do this. They literally on the phone last night with a small business administration, trying to figure out what do they need? How do they do it? Again, this program literally came out last week, and it's $350 billion that are going out to small businesses. So they told me more likely than not, it's going to be coming out on their website on Tuesday or Wednesday of next week, maybe even towards the end of the week, because they don't have a clue what they're doing. So that's the problem that we have. I would just say for every business owner, we sent out some information the other day on what they should be getting. Copies of your letters of incorporation, your tax ID, getting your financials so that you know what your payroll numbers were that you could submit to these people as soon as possible. Again, I think it's a very interesting program. I'm encouraging all business owners to sign up for it. I don't see a downside of signing up for it, but I do think that, again, unfortunately, it's going to take longer. Even though it went live today, it's going to take longer for this program to come out simply because nobody has a clue how to administer it. So we'll see what happens.
Okay. And I think this is a pretty good question that probably affects a lot of people listening is, do RMD distributions and monies count towards the threshold amounts for couples or for individuals if you're going to get a check, the CARES Act check?
Well, the checks, this is kind of interesting too, because a lot of people haven't filed their taxes for 2019. Again, you have until July 15th to file your taxes. So if you haven't filed your 2019 taxes, they're working off your 2018. If you filed your 2019 taxes, they're working off your 2019. If for some reason those numbers are different, you could file differently and say, hey, listen, 2020 was a little bit different. So there's some parts that are going to be manual, but the bottom line is if you didn't file 19, they're working off 18. If you did file 19, they'll work off that. And if for some reason 2020 is different, they'll kind of figure out a way to work on that as well too. Again, this program hit so fast and it is so massive. There are so many details that still need to be kind of considered. And I just think that as they come out, that's one of the reasons why we're planning on continuing this. We're going to have 2 sets, one of which are how do the individual programs impact you? And the second thing is going to be for business owners, what can we do to help those business owners take advantage of these programs, maintain their employees, and basically get through this so they can come out as a stronger company. And we're really excited to be able to do that.
Okay. So there are definitely some more questions, and I think what we'll try and do is answer those all offline. But if you have any follow-up questions, obviously you can send them to us separately, and we can answer them too. So it wouldn't be a visit with JFL unless there was a little humor included. So this was one of the funnier cartoons we found about making sure you're keeping your hands washed properly.
And please don't do this. Our
So
had a question saying, are you going to tell everybody they're really not supposed to be doing that? And I say,
it was pretty
really?
funny, So as Jerry mentioned, we are going to have a series of additional webinars that'll be coming up that'll address the things that are the specifics about the CARES Act and how it affects individuals as well as business owners. And we'll send out the links for the webinars. I think we'll try to do one per week for everyone. In addition, we'll be uploading a full recording of this webinar to the JFL website. And if you look at your panel, you should have the ability, I'm hoping, to be able to download the actual presentation that we showed today if you wanted to have a hard copy for it for yourself. So I'm not sure if Jerry and Jeanne, if you have any last thoughts you wanted to add?
I guess really the last thing is, unfortunately, I've been through many of these things, and I'm sure if we live long enough, we'll probably go through another 2 or 3 of them before the time we get buried in the ground. I think it's important that you know that we're here for you. This I take incredibly personally. I've been doing this for a very long period of time, and I do it because I really care for every one of you, and I want to make sure that you're okay. So we're going to do whatever we have to. Every night I'm going home with a packet of documents dealing with the tax laws and everything, so we could kind of figure out how can we make this as good as possible for you. And I want to first of all thank all of my employees. Everybody is working remote with the exception of me. Again, I'm here because we still need to get some stuff out in terms of checks to people, paperwork, things like that. But everybody's remote and they're doing a terrific job, and I want to thank them for really kind of doing whatever they have to help us out here. And again, I want to thank you for the confidence that you have in the work that we do for you. It really makes me feel tremendous knowing that we're a critical part of your life financially and that we're here for you. So again, thank you very much, and we look forward to doing what we can to make your life a little bit better.
All right. Thanks, Jerry. Thanks, Jeannie. Thank you all for participating. Stay safe. Have a great weekend, and hopefully we'll see you next week.
Thank you.
Yeah. Cool. So are we
I'm unmuted. You're on video still. I don't know if we're done.